Hi, folks. Is investing dead? Let's talk about it. Join me. Hi, folks. Welcome to The Way I See It, which is my podcast on all things investing, money, finance. This week, I have a question. Is traditional investing dead? Um, do I still need ratios? Do I still need to look at fundamentals of companies? Should I still discount future earnings to today's price and try to compare that with the market price to see if I'm buying at a discount and then, strike? What is investing today? You know, um, if you look at what's happening in the world today, everything is going up in price. Equities are going up, cryptos are going up, commodities are going up. Also, inflation is going up, and bonds are not doing badly. So what's going on? NFTs, everything seems to be like profitable. You invest today, the price goes up tomorrow. Let's back up a bit. Warren Buffett which is a guy and if you're investing, you must follow and must read, what he writes. He's smart man, He spent close to about 8 billion to buy positions in various airlines, Delta, United, and all that. He's a back and forth an airline guy. He goes at a point he wasn't into airlines. Now he's into airlines, or should we say in the past he was into airlines, and he's invested about 8 billion to buy positions in airlines. He also buys rail, so he thinks maybe transportation is a big thing. But in 2020, when we had the coronavirus, he sold all his airline stocks. So Warren Buffett was out airline stocks. This is material if you consider Warren Buffett is the guy that says his holding period is forever, which means when he buys a stock, he doesn't sell. So he basically buys, he holds. But in 2020, when the coronavirus basically hit, he was out all airline stocks. So why did he sell? The simple answer would be that, you don't have to be a genius to know that, coronavirus would stop commerce. And if commerce stops, business travel stops, flying for pleasure also stops, which means airline would not make money. So invariably, he's not going to make money on his position. So he got out ahead of the crash. Although Warren says he did get out because he wanted the airlines to have freedom to approach the US government for a bailout. He didn't want to be on the board as a billionaire. And then they were negotiating with the US government for a bailout. That would look funny. That's what he said. But I think it's more to do with, listen, this is going to be a bad bet or so. So he got out. And what happened when he got out? Well, the retail guys went in. So Warren Buffett, the Oracle of Omaha, goes out. The shares of American Airlines, for example, tumble 7.7%, major fall. And what happened? The retail guys went in and airline stocks went back up. And the retail guys that went in or bought when Buffett sold, they made a quick buck. They made some money. Yeah. And so the question is, was Warren Buffett right to sell if the retail guys were going to come in and buy? But the question really is not about Warren Buffett. Let me give you a second example, which I think would drive it home. Hertz, the car rental company. So they filed for bankruptcy May 2020. So when a stock is bankrupt or when a company is bankrupt, that basically means it's worthless, more or less. Its liquidities or its liabilities are more than its assets. So it's bankrupt, it's insolvent, it can't pay its bills. So invariably, the stock should be worthless, right? Correct. So the stocks kept on falling and they got about 40 cents to the dollar for a particular stock. Then next thing, the stock started to go up in price from about 40 cents all the way to about $4, $5, even $6. What was going on? Retail investors again jumped into Hertz and started to buy shares of a bankrupt company. It didn't matter to them that the company was bankrupt. What mattered to them was they were buying at a low price to sell to the next investor at a higher price, right? So of course, you then get this self-fulfilling hurricane where you buy to sell, the next person buys to sell, and of course, the hurricane just keeps getting stronger and stronger. But it's all built on you selling to the next person, not on the earnings of Hertz. Remember, Hertz is bankrupt. Hertz themselves try to take advantage of the price of their stocks, the bankrupt stocks going up. They try to do a public offer, and they were very, very clear on the on the offer. Basically, they wrote a clear disclaimer. And let me just read to you what they wrote. It's pretty clear that they were letting everyone know this is a bankrupt stock, right? And they basically said, we expect that common shareholders, which are the retail guys, would not receive a recovery through any plan unless the holders of more senior claims and interests, such as secured and unsecured indebtedness, are paid in full. In other words, if you buy shares of Hertz now, you are going to be at the back of the line. Should Hertz get recovered or should Hertz fail, we would first of all pay the bondholders first before we pay the shareholders, i.e., you buying the stock of Hertz. But that didn't stop anybody. Hertz kept on going up and up and up and up. So this is the point. In the normal picture of investing that we all know, if a company goes bankrupt, their shares crash. If an airline does not fly and does not make money, the company's stocks also tank because there's no revenue. If you discount revenues back to today, you get nothing. So the shares go back. But what's happening right now is you have retail investors flush with stimulus checks and the prevalence of apps like Robinhood that are able to basically go into a market or into a stock and keep that stock not just from falling, but actually appreciating in price. We don't have to go into AMC, GameStop, and talk about that. That's a different topic on its own, but you can see what happens when a stock or a company that is virtually has no revenues or has no projected revenues to meet in the marketplace, more or less. It cannot generate enough revenues in the marketplace of e-commerce with a brick and mortar operation. The stock price rose up and up and up simply because the retail investors fueled to Reddit's discussion boards were able to keep the stocks going up and up and up. And this is not just to do with stocks. Like I said, if you look at, say, NFTs, non-fungible tokens, BP sold a non-fungible token for $69 million. Now, if that was a painting, could it have sold for 69? I don't know. But clearly you can see that anything that is new out there that is called crypto or binary seems to sell a lot of, it seems to get a lot of attention, and the price does seem to go up. So we're in a new world where the new rules is not just to buy low and sell high, but you can buy high and sell higher and make a profit. And this is the new, should we say, reality in investing. Investing used to be pretty simple before. If you want to buy the price, if you want to buy a stock, more or less, what you did before was that you say, okay, what's the market price? Market price is, say, 20. Yeah, I'm going to take all the earnings of that stock, all the earnings into the future, and I'm going to discount it back to today. What's the discount rate? And when I do my calculation, maybe I discount my dividends or I discount my earnings, I get a price. And I compare that price with the market price. If my price is lower, then of course I take a decision. Should I buy or should I not buy? Is a stock overvalued or is a stock undervalued? So the whole idea is earnings via dividends or via organic earnings, or a proxy would say market share. That determines the price of a commodity because I'm buying the earnings into the future today. That's investing. Even when you look at technical analysis, you're looking at demand and supply. What's the shoulder? What's the bell? It's all demand and supply. What is demand? If the earnings are going to go up, there'll be more demand for the company. Those I buy. And that seems to be breaking down now because there's just so much money that has been pumped into the system via the stimulus all across the world. No one is working per se because we're all at home. and you seem to have funds and you can invest. So you can pay off your debt and you still have some money left over from unemployment or from the stimulus. And of course, you can invest. I mean, hey, you didn't plan for it, it's not your income. And I think all this is fueling a demand because not just is the demand there to be filled, but the dollar itself, the rates, the yields on the dollar are lower. If you go outside the US to say to Europe, you get negative rates. So if you put money in the bank in, say, Germany, you basically get less than what you put in. So you get negative rates. And negative rates now seem to be the norm outside the US. So look at it this way. If a guy had $1,000 and he tried to put in the bank, he would earn negative, less than $1,000, not even interest, he would earn less. And he has a phone and he can download an app, and that app can allow him to buy anything, cryptos, bonds, shares. And that's all really that's going on. He's not going to work. And this thing seems to be, his friend bought it last week, it's gone up this week. His friend looking like a genius. What's he going to do? He's going to do the same thing. He's going to buy what his friend is buying. He's going to go on a discussion board, hear news about this new thing. He's going to invest. And when he invests, he sells the next week at a higher price. So to him, hey, how can this be a wrong gig? You know, it looks like a no-lose situation. And that's really what's going on. The Fed itself is taking away the risk in the market, the US Federal Reserve, by backstopping purchases. So the Fed is buying bonds, basically. And that's free money in the economy. And the Fed has said and demonstrated that if they have to, they will buy equities or they would buy any asset to keep the economy basically humming. So the risk is gone. And where there is no risk, there's only then reward, more or less, because risk is what keeps you sane. And really, that's what's going on. So investing technically is not dead, but excess liquidity has changed the game in the market. So like I said, right now, you don't need to buy low. You simply need to buy and then sell higher. That is the new mantra now. Add into the picture the fact that in the US, home prices, especially out of the cities now, seem to go up and up and up. So if you have a home, you can take out a home equity loan and turn around and use that home equity loan to then invest back into the market. Rates in the US are so low right now that if you then borrow funds, you're paying back at a very low rate. So all this is driving this excess liquidity, excess demand back into the market. Where if you then look at the PE of the market, it's very high, but flows are also very high. So it's an inflection point to say, and this time we might look back at this time in history and be like, what were we doing? Or say, wow, we should have taken advantage of that opportunity. Is it an opportunity right now to trade? I'll say yes. So if you're trading right now, I will say take out profit when you can, take out your principal when you can. And if you want to stay in the market, be careful. If you've made some money, you've been very lucky, take out your principal, take out some profit, bank it. If you still want to stay in the market, that's good. But keep it in mind that what's going on now is called the greater fool theory, the greater fool theory. And that's an actual term where it says I can buy today as long as I can sell the same asset to someone else tomorrow. It doesn't matter what the earnings are. It doesn't matter what the PE is. All that matters is, can I get a market for this asset that I've bought tomorrow? If I can, then great. I buy and I sell. Long term, the market will correct itself. And what will be the trigger for the correction? Either when the Fed stops backstopping assets. So when the Fed stops saying when we're going to start to slow down on our buying, or inflation. One of them is going to happen. Something has to happen because we cannot keep on buying bonds forever, nor can prices stay low forever. If there is liquidity and demand and an ability to spend on consumables. So one has to give. And once that starts to give, then you're going to see an unraveling. So you're going to see assets now becoming priced back to earnings. And when that happens, be ready for it. So buy quality, hold quality, If you are trading, take out profit, bank it, and be ready for what's going to happen. It's an opportunity, I won't lie. There's lots of money to be made. So if you can make the money, or if you're fortunate to have the liquidity, take advantage of it. So investing, still, the demise of investing maybe has been overrated. It's still there. Let me just go back and tell you in summary. Start early, buy, be constant, stick to your plan. Ignore Mr. Market. He's very irrational. Stick to your plan, and in the end, you are going to make it. All right, guys. Thanks for listening today. I'll see you all next time. Bye. Keep following us on Twitter, FinPlanCarlo@your1, and also on YouTube. Take care, guys. Bye.